Hi, Andrew Packer coming at you with a bonus video. After looking at news events this past week, mostly the crisis going through Europe, with Greece finally waving the white flag and asking for an IMF EU bailout, it seemed important that I come back and talk to you a little bit once more. It's really no big surprise that the next big thing I see blowing up is, well, countries and their finances, or as it's called, sovereign default. We've seen it this week with Greece. They finally got their big downgrade from Moody's to A3. So, hey, they still have an A rating. Despite all those bad things you hear about the country, it's still considered investable by the big folks on Wall Street. Now, the fascinating thing about this A3 rating is it means that every 3 months, Greece is paying the same price that a German investor would get on a 10-year bond in Germany. That's a pretty big differential, considering they're on the same currency. Greece's 3-year bonds have a 12% yield. Compare that to the 3 to 4% yields on similar Western countries, France, Germany, United States, Canada. It's much more in a narrower range like that. But honestly, when you read into the books and finances of these countries, they should be trading around 12% as well. Now, what's really outrageous is what happens with this sort of sovereign default crisis. It's the biggest sort of source of income. It's the biggest market out there. Every country's debt, added up into a big pool, it's trillions. It trounces corporate bonds, it trounces the stock market, it trounces commodities, it trounces anything else that you can think of, save the total value of outstanding derivatives, which is more of a side bet. So, does it really count? Yes and no. But the biggest unleveraged pool of money out there is all in sovereign debt. And when these countries start to default, and Greece is just the latest one, there's going to be more. Spain and Portugal already look to be on the chopping block. When these countries default, the financial system will become paralyzed. Bond prices will fall, yields will soar, just like in Greece. It's happened there, it will happen in other countries. This isn't the last we've seen of it in 2010. And when the financial system starts to become paralyzed, the best thing that you can do is take a look at what's being shown by the credit crunch short indicator. It's the easiest way to go short. I wouldn't recommend you going short Greek bonds or anything like that at these yields, and the prices have already had a huge tank already. But the credit crunch short indicator is a forward-looking measure, looking at the decline in fundamentals and combining when a stock is ready to sort of make that trigger point between rising an egregious amount and people finally pricing in bankruptcy and seeing the price of the stock plummet. Now, the problem with the credit crunch short indicator is that it doesn't cover financial companies, which are the ones that would be most affected by a sovereign default crisis. However, there's a way around that. Rather than using the Altman Z-score, the financial composite of a company's health, we're taking a look at the Texas ratio for companies like banks. The Texas ratio just measures non-performing loans versus the total outstanding amount of loans and the equity of the bank in question. When that number reaches 1, the bank is literally bankrupt. The bad debt equals the good debt. They cancel out. Boom, bankrupt. It's clear, it's simple. But there are hundreds of bank companies out there that have Texas ratios above 100. In other words, they're not just broke, they're broke 100 times over. It's pretty shocking and scary. And just the number of banks exceeding 1, the minimum amount of bankruptcy, is in the thousands. It's a pretty scary and dicey situation. And with the Fed looking to eventually start selling off all that mortgage debt they've been accumulating and raise rates and other things to recognize the so-called recovery, things are looking pretty dicey for U.S. investors in treasuries or even in banks themselves. So in the weeks and months ahead, not only do I get to use the credit crunch short indicator to identify non-financial companies with a high risk of bankruptcy, I'll also be using it to apply it to the weaker regional banks, the ones I've identified as small enough to fail, and fail spectacularly. I've already looked at using it on some of the bigger banks, but because of the effects of government intervention with those, it's a little dicier situation. But that's what happens when you mix politics with financial markets. So that said, I think it's extremely important to take a look at what's going on, not just, with your local bank or local stock market, but the entire world. And at the rate things are going and where things are going, it's not going to end well. It's looking a lot like some of the lessons in The Big Short. You can see these things coming. There's a storm on the horizon. Start battening down the hatches now.